Good morning, good afternoon, everyone. My name is James Bogart. I'm CEO and president of Bogart Wealth. Today, I'm going to be doing a presentation on the retirement planning timeline. Now, just a couple quick administrative items. I do have the question and answer box open as well as the chat box open. Please feel free to ask questions as I'm doing this. Also, we do have a survey at the end of it. Really do appreciate feedback. I will be recording the webinar and we'll be following up afterwards to see if there's any questions if you'd like a copy of the recording. I also will have it up on the website probably tomorrow, maybe Friday. But with any of the webinars that we've been doing, I've been recording them all. They are all up on the website. So if there's other topics you want to hear, please feel free to watch one of those videos. And if there's anything along the way, just let us know. All right, real quick introduction to Bogart Wealth. So Bogart Wealth's what's called a registered investment advisory firm. We're managing a little bit over $1 billion of client assets. It's roughly 700 households. About 90% of those are EXXONMOBIL. We are true fiduciaries for our clients, so legally obligated to put your interest above our own. No hidden agendas, no conflicts of interest, extremely transparent in terms of how we're compensated. We have 18 folks as part of my wealth management and planning team. We've got 4 as part of our tax team. You know, and our core competencies are financial planning, investment management, tax optimization, as well as tax preparation. I do believe that all 4 need to be seamlessly integrated. You know, the baseline is the planning process, but then we want to build and enhance, find different ways of keeping more money in your pocket. We have 3 different offices, one in McLean, Virginia, one in the Woodlands, Texas, as well as the one in Houston. I am actually in the Woodlands office today. I typically bounce between really mostly the Virginia and the Woodlands office, but we do also have clients in Houston. Our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. I always emphasize the intergenerational part of our mission. Your kids and your parents can be some of the largest variables of anyone's financial plan. Specifically with your children, we know the impact that we can have at an early age, and it's in our best interest to also have a relationship with them. But I think it's also important to give them access to certified financial planners to help them with enhancing and optimizing and doing some of the things they should be doing early on. With regards to any of these sessions, you know, one of our calls to action is to actually offer to sit down and run your numbers. We do this absolutely no cost, absolutely no obligation. It's a phenomenal way of just establishing a baseline of where you're at. You know, I think in the current environment, it's really important to understand, you know, essentially where you are and be in a position to be able to make decisions quickly and respond to whatever the environment is. Obviously, a lot of companies are going through employee reductions, headcount reductions. We've made it very easy for us to be able to act on those and enable decisions very quickly. So today's talk is part of our retirement readiness series. We've been doing these now for several years. Historically, we've been doing them live. With COVID, we've now gone more web-based with them and also recording them. But today we're going to be talking about the retirement planning timeline. We do a presentation on retirement income planning, one on Social Security and Social Security strategies, one on tax planning and tax optimization strategies, one on estate planning and estate planning strategies. We do one on net unrealized appreciation and post-retirement strategies, one on long-term care and long-term care insurance. And then last but certainly not least is Roth versus traditional 401ks and IRAs. This list came from our audience, and recently we've been adding in different topics to talk to, things that people have been asking us. If there's a topic you'd like to see, you know, please at a minimum send me a note. We'll add it to one of our existing ones, or we'll just make an entirely different presentation along the way. All right, so with regards to today's talk, we're going to break down the retirement planning timeline and some of the different sequencing of not only things you need to think about, but also things that we think you need to learn. So we're going to talk about a little bit of some of what we need to be looking at when we're over a year away from retirement, some of the things we need to be looking at when we're within a year, right at retirement and post-retirement. Now, candidly, it's going to seem like I'm spending a ton of time on over a year out, but some of that stuff does overlay on a related basis. So when we're over a year out, that's when we really want to understand the rules, whether it's the pension, tax rules, some of the rules around the 401k. We want to understand the different investment choices, understand some of the different ways to optimize the 401ks and savings plans. And if you haven't run your numbers, there really is no such thing as running them too soon. Have a plan, and have a plan as soon as we possibly can feel comfortable doing so. That's also where we'll want to evaluate contributions. And then if you are thinking about hiring an advisor, you consider it at that point in time. Have a trial relationship with them. It might be a small amount of money, but before you go to actually retire and the bigger money's coming through, that's when I think it's really important to establish that relationship and understand how they communicate, how they service their clients, how they manage money, how they integrate different strategy, planning, tax, etc. All right, so when we talk about the rules, the first thing we want to understand is the discount rate for the pension lump sum. And with this, this was actually really fundamentally established based upon the 2006 Protection Act, which defined the rules for any company that was offering a lump sum option on their pension program. It also defined the discount rates that can be used. It defined the actuarial tables that can be used. It clarified a couple things not necessarily related to the pension itself, but it clarified that non-spousal beneficiaries can do rollovers. It also clarified if you have after-tax balances that those can be rolled over to Roth IRAs. It forced companies that were offering a match on their 401k to allow diversification options. So many of you, for example, with the EXXONMOBIL plan, prior to 2006, in order to get the extra 1% match, you had to have it all go into stock. Well, after the Pension Protection Act passed, that was when it became eligible to be diversified. And then it also clarified and defined IRA as well as 401k contribution limits. So jumping back, talk a little bit about the discount rates. So because of the Pension Protection Act, a lot of companies have what we call a grandfather category as well as a non-grandfather category. Now for the EXXONMOBIL pension program, for example, the grandfather category was defined as anybody who was over the age of 50 at the end of 2007, had more than 10 years of service before January 1st of 2008. And for them, there was no changes to the rules. More simply, what it means is if you were over 55 and had more than 15 years of service by December 31 of 2012, you used all of the legacy math. And so some people just look at it based on their birthday. If you're born prior to 1958 and hired before 1998, you use this grandfather category. And for the grandfather category, the math is actually very, very simple. We take 95% of the 30-year treasury rate, we round it to the nearest quarter point, and that will determine the preceding quarter's discount rate. So for grandfathered folks, we know that the fourth quarter as well as the first quarter, the discount rate's at 1.25%. We are now modeling and sending projections out for the second quarter rate. Second quarter rate looks like it's going to be 1.5%. And then now, based upon the trajectory of the 30-year treasury rate, we are starting to see it drift up a little bit, but I'd be willing to bet the second quarter for sure. And then going into the third, they're going to be higher than the first. The other thing for the grandfather category is they use the EXXONMOBIL year 2000 mortality table. So that's right, the mortality table has not been updated in 20 years now. So legacy, and obviously the longer we've gone, people are living longer, so the mortality tables are adjusting out. Now, based on this, based on the Pension Protection Act of 2006, we now have what we call the all other category as well. Now, for the all other category, this was anybody who was under 50 at the end of 2007, or more specifically, they were born after 1957 and hired after 1997. Now, for this age group, the math is actually a little bit more complicated. This is based on high quality corporate bond yields. There's three segments, segment 1, 2, and 3. They couldn't be more original with the naming of them. But segment 1 is replicating short-term high quality corporate bonds. Segment 2 replicates intermediate term corporate bonds. And segment 3 represents long-term corporate bonds. The IRS publishes these rates every month. We typically see them about second week of the month. Now, for the all other category, non-grandfather category, it's important to note that the only months that impact the effective discount rate, what will actually apply to the lump sum, are the last 2 months of the preceding quarter. So for example, October meant nothing in terms of the effective rate. The second quarter discount rate of 2021 is going to be based solely off of what happens with the corporate bond rates in November as well as December. Now, with both the grandfather and non-grandfather categories, every week we're sending out pension projections. If you'd like to receive those, just send us a note. We're more than happy to add you to the list. And it gives a good indication of trajectory. So for the non-grandfathered category, we know that the discount rate for them was also at a new historic low for the first quarter. It does look like the trajectory for the second quarter is that rates are slightly moving up. Based on last Friday's ending value, we noticed that the discount rates were projecting to come up by 0.07. So it's a little bit of an uptick, not significant, but it's enough that it will cause the lump sum values to go down a little bit. Now, the other thing with the non-grandfathered category is that they use the IRS mortality tables, which are released by the IRS. They're updated every single year. And so that's where the big difference is between grandfather and non-grandfather on the mortality side is the IRS is updating these every single year. And so we're seeing higher mortalities or living longer, which longer means bigger lump sums. Now, one thing from an optimization or execution perspective with the non-grandfathered category is in order to take advantage of that quarter's discount rate, your benefit commencement date has to be within that quarter. So for example, for anyone who wants to have the first quarter discount rates, the latest they can retire and effectively execute their benefits is going to be March the 1st of 2021. Whereas with the grandfather category, as long as you work all the way through, you actually can have your last day of employment be March 31. You could then have your benefit commencement date be April 1 and still have your effective date be in the first quarter or get the first quarter discount rates. So it's a little nuance between the two different age groups. All right. As I said, we have a whole webinar that we do just on discount rates. I'm going to be doing it again on December 2nd, but I just recorded one, was it last week, 2 weeks ago, related to discount rates, and it's up on the website as well. All right, a couple other things with regards to the 401k program. So the 401k contributions, they have clarified that for anyone in 2020, if you're under the age of 50, you can put 19,500 in. If you're over the age of 50, you can do 6,500. Now, they also clarified, and this is a 2020 number, that if you're under the age of 50, the total amount that you can put into the 401k is 57,000. If you're over 50, it's 63,500. And by the way, for 2021, they just announced the numbers for 2021. They did not change the pre-tax and catch-up contributions amounts. So they stayed at 19,500 and 6,500. They did increase the maximum amount that could go into the 401k. So it's 58,000 if you're under 50, and it's 64,500 if you're over the age of 50 with the catch-up contribution. Now, what this means is that you're able to put your before tax amount in. So let's just use 2020, and let's use somebody who's over the age of 50. So that means that you're able to put the 19,500 in plus the additional $6,500 of catch up in on a before tax basis. Then it means that your company can come in and put a 401k match in. Let's just make the math easy. Let's say that it's $14,000. So that'd be a total of 40,000 in. So what it's saying now is that with the 63,500 cap, you can put an additional $23,500 in on an after-tax basis. Now, I'll talk a little bit about after-tax contributions in a few minutes. It does introduce some different strategies, but it's one thing as we talk about optimization and saving while you're accumulating, we love seeing money go in on an after-tax basis. Many of you who've heard my events before, you'll hear the joke that I use a lot, but the financial planner in us will have you work through 80, you die at 81, we'll have you save every dollar you make, leave nothing left to live. Obviously, it's a bad joke, and we need to find that balance in there, but there's a lot of truth to the underpinnings of it. If the longer you work, the more you're going to have, the more you save, the more you're going to have. And so we'll talk about sequencing of savings and where we want to prioritize, but it's important to know that you do have the ability to put up to 63,500 in for 2020. For 2021, it's going to be 64,500. I'll update the slides soon for that. All right, now past the 401k, you also have the ability to put money into an IRA account. Now, a lot of folks don't understand the difference between an IRA and a Roth IRA. So IRAs are where you can put money in on a before tax basis. It's growing completely tax deferred. When you take the money out, you have to pay ordinary income. Roth IRAs are where you put money in on an after-tax basis. And as long as it's been in existence for 5 years and you're over the age of 59 and a half, all of the growth comes out tax-free as well. Now, the contribution limits for IRAs and Roth IRAs are the exact same. If you're under 50, it's $6,000. If you're over 50, you get to do an additional $1,000 of catch-up, so $7,000 total. Now, the challenge, you could probably imagine, we're very biased. We want to see as much as we can in the Roths. The issue with Roth is that there's only two ways of getting it in. One is through a contribution. The second is through a conversion. Now, contributions, if you're married, you're phased out at $206,000 of income. So a lot of households, especially when they have the ability to have discretionary savings, they're over the income thresholds. They're not able to put money in as a contribution. I'll talk about some strategies in a minute. But then the other is conversions. So conversions means you take money from an IRA, pay ordinary income, and you move it over into a Roth. So with Roths, as I mentioned, the tax-free growth, tax-free withdrawals as long as it's over 59.5. Another very significant portion of Roths is that they are not eligible for what are called required minimum distributions. You'll see the acronym RMD, but a required minimum distribution is when you turn 72, you're forced to start taking money out of retirement accounts, specifically 401ks, IRAs, and Roth 401ks. But Roth IRAs are not. Also with Roth IRAs, your beneficiaries will inherit them with all of that tax-free growth. It's a great tool for tax diversification strategies along the way. All right, I had a question come in. Since I will be leaving after January 31st, how can I maximize my pre-tax contribution and catch up? All right, so my recommendation for anybody who's going January 31st as part of the early retirement program is we're going to get maxed out on the monthly contribution limit, which is 20% of your monthly pay for the EXXONMOBIL program. So I do recommend put everything 20% in on a before tax basis. And then I also recommend max out your catch-up contribution for that month. And again, also on a before tax basis. Now, it does take one pay cycle for that to update. So I typically would say anybody who's going, we need to make sure we make that change before December 15th so that we can have the January paycheck automatically structured to max that out. That's the best we can do. All right. A couple strategies related to, and especially while you're still working and accumulating, one is what's called a backdoor Roth contribution. And so what this is it's a great strategy, especially for someone who does not have an IRA account. That's the most critical part of this, but you don't have an IRA account. You have the ability to actually put an after-tax contribution into a traditional IRA and then immediately convert it over into a Roth, and it's completely tax-free. So if you're over 50, it's $7,000. Now, a lot of times we see it while most of our clients, they're putting most of their money into their 401ks, and that's where the material savings that are happening. But if you get to the point where you've got the ability to save some after-tax money, and we want to talk about positioning and structuring, love doing the backdoor Roth as a strategy for that. There's also another nuance in here called the mega backdoor Roth. Now, the mega backdoor Roth is the same concept as the backdoor, except for we're going to use the 401k as the conduit and then convert that over to a Roth IRA or Roth 401k, dependent upon the plan. Now, I mentioned earlier the after tax. So I go back to that whole contribution example where I said you can put $63,500 in. Well, what I meant was you had $26,000 going in before tax. If the company's doing a match, we know that EXXONMOBIL is not for this next year and foreseeable future. We haven't heard anything when it's coming back yet. But you then have the ability to put the remaining balance. For 2020, it's $37,500. If for 2021, it's going to be $38,500 on an after-tax basis. So what we can do here is put the $38,500 in to the 401k, again, on an after-tax basis, and then do what's called a tax-paid withdrawal from the savings plan. You can do it twice a year, where we take the after-tax amount, we roll that to a Roth, and then we also take the respective gain out. The gain would then go over into a traditional IRA. By the way, just real quick note, this is very different than a Roth conversion within the savings plan. I have a whole webinar that talks about the execution of this. This is also a great example when we talk about having a starter relationship with an advisor. Let us help with these types of things in executing. So a question came in, why does a pre-existing IRA prevent someone from doing a backdoor Roth contribution? Thanks for asking that question. It's a great question. So when we go back and talk about the backdoor, the reason that a pre-existing IRA it doesn't necessarily prevent, it just doesn't make it as effective. So if you have a pre-existing IRA, it means that there's most likely before tax money sitting in that IRA. If we do the after-tax contribution to the IRA and then convert it over, it's actually going to get treated as a partially taxable conversion. For a lot of the people who are able to do these types of strategies, usually they're in higher tax brackets. Obviously, you're making over $206,000 that you can't do a straight contribution. And so the incentive or the benefit of doing that conversion where it creates a tax bill does start to impact the benefit of continuing to do this. So the whole reason why I say it matters to not have an existing IRA is because of the taxability associated with that conversion itself. And by the way, when we talk about this mega strategy, I mentioned as you take the after tax out and goes to the Roth, the gain has to go to an IRA. It can have an impact on if you were previously doing the mega backdoors. We just need to look at what that gain amount is and see what makes sense for your situation. But ultimately, I look at the ability to put $37,500 in on an after-tax basis to the savings plan, or in 2021, it's going to be $38,500. Obviously, both of those numbers are significantly bigger than $7,000 on the Roth. Or doing the backdoor Roth contribution. So it's where we have to look at strategy and what makes the most sense for you as we're developing out that plan. Great questions, though. Thank you. All right, a couple of the things we want to do while we're still working and really specifically understanding the EXXONMOBIL investment options. So we've got the EXXONMOBIL stock, we've got the equity units, we have extended units, we have international units, we've got bond units, we've got the balanced units, and then we have common assets. So EXXONMOBIL stock, without a doubt, it's the single stock, so it's got higher risk. We're experiencing that without a doubt this year. It's the worst performing asset within the savings plan this year. It does have the ability to do what's called net unrealized appreciation. Now, net unrealized appreciation, I've got a whole dedicated seminar to it. But if I was just to give a real quick cliff note of what NUA is, it is a tax strategy. And a lot of people think that NUA is this magical solution to all of the woes. No, it's really not. It's a way of saving some tax dollars. Now, NUA, what it is if you left every dollar within the savings plan or rolled it all to an IRA, as you pull it out, again, all the pre-tax money, it's going to be coming out as ordinary income. With NUA, you have the ability to take your lowest cost basis shares, move it over to a non-qualified account, an after-tax account. You'll pay ordinary income on the cost basis, so what you would have bought those shares for, to be able to sell the shares at long-term capital gains rates. And so we know that ordinary income rates, at least currently, go from 10% to 12 to 22 to 32 to 30, 22 to 24, 32 to 35 to 37. So those are the marginal tax rates. We know that long-term capital gains rates go from 0% to 15% to 18.8% to 23.8%. The point is that long-term capital gains rates are always lower than ordinary income rates. And so what NUA is it's actually playing the difference between what would otherwise be taxed at ordinary income rates and having them go out at long-term capital gains rates. All right, I had another question. What's the downside of doing a mega Roth? Why would someone not do the mega Roth if they have after-tax contributions in their 401ks? The downside really is the execution of it. You have twice a year that you can do these tax paid withdrawals. I would also say a big risk is a lot of people confuse tax paid withdrawals with Roth conversions within the plan. But if you have the ability to save more, I go back to my joke, right? Save, the more you save, the more you have. But if you have the ability to save on an after-tax basis, there is no true downside of doing it other than the hassle of the execution. And then to the earlier question too, in order to do the tax paid withdrawal, you have to take the gain portion out. So that does create now a pre-tax account, which could preclude you from doing the backdoor. But in every sequence that we do this, I would rather leverage and take advantage of tax paid contributions and have them into an environment where we can be doing this mega backdoor. And for those that are going to continue to work for several years, I like getting the tax paid credit balance out of the savings plan as quick as I can, because while that tax paid is in the plan, it's growing on a pre-tax environment. Anything that's pre-tax, that's ultimately part of the calculations for future required minimum distributions, and it's not growing tax-free. Now, that said, we need to understand what the implications would be with some other strategies, for example, this NUA. Now, here's why. Now, example of the savings plan. With the savings plan, the pre-87, post-86 is what I keep talking about for these tax paid contributions. This is a household that's done a tremendous amount of after-tax contributions, $274,000 roughly, that they've put in on an after-tax basis. Now, there is a difference between after-tax as well, the tax paid versus what is listed as the after-tax. The after-tax dollars that are listed on the savings plan include the gain. So if I go back to here, here's the line item that said after-tax. Well, the 274,000 is now worth 562 in this example. So he's got a significant amount of gain off those after-tax contributions that he's put in there. Now, the reason that this matters is because when we look at NUA, we look at what those lowest cost basis shares are. Now, this is an individual that has really sold almost everything that's above $15 a share, really specifically trying to target those lowest tranche basis of shares. But then we also want to look at what the contributions are. So where we can put money into the savings plan, we want to also make sure anybody who's over 50, they get their catch-up contributions in. And the reason you know this is, for example, they're putting 11% on a before tax basis, 0% Roth, 0% after tax. But this particular person does not have any catch-up going in. This person now, we took the same thing and we added the catch-up contribution line, and we see a very specific dollar amount. The way you know you're doing catch-up is all of the pre-tax and under catch-up, non-catch-up contributions are a percentage base. With catch-up, they're listing a specific dollar amount. All right. Related to this tax paid, I wanted to come back to this point real quick. The reason tax paid is so important is because at retirement, you've got three options with this. You can withdraw it, you can roll it to a Roth, or you can actually apply it to the cost basis of the NUA shares. So again, we want to look at all three of those in terms of strategy that makes the most sense for your situation. Someone asked the question, with the current share price of EXXONMOBIL, is it worth it to do an NUA? Yeah, it's tax savings. So one thing to note with NUA, we're not selling any shares when we execute NUA. I've got some examples coming up here in a minute of what that distribution will look like. NUA, the optimization point will change. And I've had the question a lot recently, should I sell my high basis shares, buy them back to have more low cost basis shares? You know, I think everyone's situation is going to be different. I do believe in the value of NUA and the tax savings at long-term capital gains rates. I also believe in having tax paid credit balance and having the ability to get that over to a Roth IRA. So we got to look at your situation and how much shares you have that are low basis. Like, for example, I had a client recently that 75% of his shares were below $30 a share. Okay, well, does it make sense for him to ratchet down the remaining 25%? Maybe, maybe not. In his case, he had some tax paid that he wanted to flip out to the Roth. So we just got to talk about the strategy related to you. But again, because we're not selling the shares, even when we go to execute NUA, the assumption would be is that we're going to sell them at hopefully a higher price point than where we are today. But if we don't execute NUA on anything that's above the current market price of the stock, you're going to have gain in there. So like, for example, if you have cost basis shares at $14 and $15 a share, stocks trading at 38, even if you sold it right now, you still have gain there. Not recommending selling it, by the way, but you would have gain there. So NUA would still have benefit. All right, a couple other things related to the savings plan. Equity units, this is tracking the S&P 500 index. It's 500 of the largest US companies, represents 70 to 80% of the market value of all publicly traded US companies. The extended market units, this is tracking the Wilshire 4500 index. It's mid and small companies. It does include all publicly traded US companies minus the S&P 500. The international units, this is tracking the what's called the EFI index. It's large and mid-cap companies in 21 developed countries. I won't read the list, but it's approximately 918 companies. It's representing about 85% of the market capitalization of each of the countries in the index. Then we have the bond units. Bond units is tracking the Barclays Capital Corporate Index, represents about 17,000 bonds traded in the US. It's a mix of government, corporate, and mortgage bonds. It does not include high yield bonds, municipal bonds, inflation index bonds, and any non-US denominated bonds. Now, one thing real quick, I would talk about the bond units. I'm not a big fan of bond units in the savings plan. And the reason, again, everyone's situation is going to be a little bit different. But when I look at someone's overall asset allocation, I have to include the value of the pension lump sum in their total net worth. Whether you decide to take pension or you decide to take lump sum, it is a number. It's a real number. And especially if you're already vested, it's definitely coming. We obviously, with regards to the pension, we've got sensitivities to interest rates. We talked about that earlier. But the point is if I look at someone's overall allocation, most of them have a very large bond exposure because of the pension lump sum. Because of that, I don't really like having bond units in there. I would also say that a lot of people who are investing in the Barclays Capital Aggregate Index, this has an average duration of almost 9 years. What that talks to is how sensitive it is to interest rates. And interest rates and bond prices move inverse to each other. So rates have come down and caused these to perform really, really well. But at some point in here, what's gotten us to these low interest rates isn't going to keep going on, and rates are going to rise, which is going to cause the value of these to go down. Now, I will admit, I've been saying this for almost 3 years, and rates have continued to come down. I think it took a pandemic to cause rates to go even lower. But it's one of those things that people don't necessarily truly understand the risk with being in something like the bond units. And for that reason, between that and looking at the savings plan, I'm not a huge fan of having bond units in the thrift. All right, balanced fund. So the balanced fund is kind of the one-stop shop option for anyone who just wants a simplified mix and being a little bit more diversified in the savings plan. It's made up of 35% in the equity units, 15% extended, 25% international, 25% bond units. For the same reason I just mentioned with bond units earlier, I'm not a huge fan of the balanced fund, but if you want simple, it's a decent way of going. And then lastly is the common assets. Now, common assets is the EXXONMOBIL savings plan cash component. It does have a dollar net asset value target. The yield is variable. It's actually higher than pretty much any other money market. Last I saw was like 1.1%. That's down from at one point it was in the threes, but all money markets have been coming down. And here's just listing the returns as of the end of 2019 for each of the different components. I think anybody who's been watching their savings plan, they know that stock has been the anchor, not only for 2020, but also for the last 10 years. And so pretty much every asset class has performed better than the stock. That said, where you have stock, I'm a firm believer the stock's still being oversold. Let's be a little bit patient with it. Let's not jump to sell it even at this little bit of a bump up here at 38. I think realistically, the fundamental value of all the different research we're following on the stock is somewhere in the 45 range. And so dependent upon your exposure, your position, we should have a conversation, have a diversification strategy. If anything, 2020 has really demonstrated why someone shouldn't have all of their eggs in one basket, i.e. all of their eggs in EXXONMOBIL stock. But let's also be prudent in terms of what execution prices we diversify at. All right, so when you're over a year out, and I apologize, I'm going a little quick because I've got a lot of content I want to cover still. When we're over a year out, this is where we really want to evaluate contributions. We want to look at what investment choices we're selecting. We want to look at how much is going in after tax versus before tax, and then really monitor that tax paid credit balance in conjunction with NUA strategies, but also looking at the mega backdoor Roth strategy as well and what makes sense for you. And then part of the planning process, this is something we're going to be helping with. Now, the pension program, this is changing gears a little bit, moving away from the savings plan, but I love this slide. This is actually very old now. It's 13 years old. It's from 2007, but it shows the formula of how the pension's calculated. So pension very simply is 1.6 times years of service times average pensionable pay. There's a Social Security offset, and that's what creates the single life annuity option. Now, from there, that's what we then can determine what would be the present value of the lump sum. Now, for anybody who makes over $285,000 of compensation, you're going to have what's called a supplemental pension program. So what we do is we then back out what would be that annualized comp above what's called the 401A-17 limit, which is $285,000 for 2020. Anything above that is going to go into the supplemental category. Now, by the way, real quick, if anybody retiring next year, that 401A-17 limit has moved up from $285,000 of income up to $290,000. It's not changing the total amount of your pension. It's just changing what will be supplemental versus not supplemental. But just important to understand the numbers. Now, with the annuity, I am very, very much in the category of understand your options and absolutely understand the implications. Now, with the annuity, we have the ability to take an annuity stream indefinitely for the rest of your life, or we can take the lump sum value. Now, if we take the annuity, the principal value goes to zero, and we've got guaranteed cash flows for the rest of your life. With the annuity, I look at that as a hedge against longevity risk. If we decided to take the lump sum, that's a hedge against inflation risk. Both are risks. It's important to understand your comfort level with risk. To me, if you take the lump sum, you have to be okay with taking on some market risk because it's not going to always go straight up. You've got to have the ability to understand that markets go up and go down. But if you take the annuity, then you need to have another bucket of money available to grow to offset future inflation risk. I had a question. What is the non-qualified lump sum in the pension option? So a non-qualified lump sum is what I was just mentioning a moment ago, is the supplemental pension program. If you're an executive, you also have what's called an additional payments plan. Now, for the non-qualified, so the supplemental pension program as well as the additional payments program, those are only available as lump sum, and they are 100% taxable the year of retirement. So for anyone who's fortunate enough to be in that category, we really need to be doing some tax planning for the year of retirement, talking about ways of mitigating that tax bill as best we possibly can. All right. Now the savings plan, a couple different things with regards to how to distribute the savings plan. One thing I would say is in the base case, leave the savings plan at Voya. Voya is a pretty decent platform, very low cost. Until you're really comfortable with what your distribution options are, leave it there. Now, related to that, though, you've got a couple options. You can roll it to an IRA. You can take what's called a lump sum distribution, or you can roll it out as an annuity. I've never seen somebody roll it out as an annuity. But what a lump sum distribution is it enables somebody to actually take advantage of moving your stock as stock. It's also where NUA is part of the strategy. But with a lump sum distribution, technically you can take the entire amount out as cash, becomes 100% taxable. Never seen that either. You have the ability to take stock in kind, which is again where NUA shares go, as well as anything that's not NUA. Or with a lump sum, you can just have everything go to an IRA in the form of direct rollover, no tax impact there. So here's kind of what we call our circle charts, but it shows the typical distribution of a savings plan. So for anyone who has EXXONMOBIL stock that's NUA, we'll have that moved out into a non-qualified account. So a joint account, trust account, and then those will all just hold as shares. For anybody who's got shares above that execution price, we move those shares out and they go to a traditional IRA as shares. And then if you have other investments, hopefully you do, but if you have equity units, extended international common assets, balance units, those will all be cashed in and they go to an IRA as a direct rollover, no tax impact there. And then if you happen to have any Roth 401k or tax paid credit balance, both of those will go to a Roth IRA. With regards to this, in terms of understanding rollovers, typically why people roll money out of the savings plan, so they can have the option of professional management. They want to reduce stress. They want to have greater investment choices, more fixed income choices, and you also have a lot more flexibility with regards to accessing cash flow. One other thing I would throw in there too, especially as we talk about diversification strategies related to EXXONMOBIL stock, having the shares out in a brokerage account, whether it's an IRA or an after-tax account, we can be very specific on the execution price. So we set the dollar figure and we execute accordingly. A lot of people are doing rollovers. It's about $22 million hourly, $200 billion annually is being rolled over. All right. So the other thing I wanted to talk about related to this over a year out is understand where you've got your retirement income coming from. And it's kind of more of what we call the 3-pillar stool. But with Social Security, you have to understand Social Security will still be there. I do think that there's reform coming. But Social Security was never designed to replace 100% of anyone's income. For the lower income thresholds or lower spending households, it's replacing 90%. For those that are theoretically have unlimited income, it's going to be less than 1%. For the U.S. median, we find that Social Security replaces approximately 40%. For the typical EXXONMOBIL households, anywhere from 10 to 30%. The next category is the pension program. Now, with the pension program, also not designed to replace 100%. On the low end, it was designed to replace 12%. On the high end, it was designed to replace 70%. And as I mentioned earlier, we know the formula. It's 1.6 times years of service times average pensionable pay minus Social Security offset. And that's what determines your single life annuity option. Now, for the typical ExxonMobil career employee who's retiring at 60, the pension program will replace approximately 50% of what they're spending. And so if you've got, for example, the pension replacing 50% of your spending needs, if you've got the Social Security replacing 10%, for example, well, that's only 60% replacement of what you were previously living on. If that's the case, I don't know a whole lot of people who retire and want to live on 60% of what they were before. And so we then need this third category, which is savings and investments, typically 401ks and anything you're doing outside of that. All right, a couple other things to talk about here. Especially when you're over a year out, we want to understand cash flow planning and start building out that cash flow plan. So we're going to understand Social Security. We're going to understand the pension and annuity options. We're going to understand any type of short-term liquidity option needs that you're going to have. And then look at different investment choices, whether it's individual bonds, whether it's buying individual stocks, doing things like cover calls. Having a plan for how you're going to generate your cash flow. It's very, very important, especially because we need to be able to adapt the plan for future changes. But understanding the investment strategy, but also how that investment strategy is going to provide for your paycheck. And then next up, I want to talk about some tax stuff. And so in order to have tax planning, we want to understand the taxable effect of each of the different buckets. So for example, Social Security, a portion is taxed as ordinary income. Pension income, interest income, IRA and 401k distributions, all of those are ordinary income. Qualified dividend income as well as capital gains rates, they're all taxed at long-term capital gains rates. I'll talk about that in a second. And then Roth IRAs, as I mentioned earlier, not subject to tax, as well as liquidation of any investment principal, also not subject to tax. So with regards to long-term capital gains rates, I talked about this a little bit earlier, but this also presents a planning opportunity. We know that long-term capital gains rates go from 10% to 12 to 22 to 24 to 32 to 35 to 37, just like we know that capital gains rates go from 0% to 15% to 18.8% to 23.8%. And so this is where, as we're looking at harvesting losses, harvesting gains, tax optimization is a very big part of enhancement of value and keeping more money in your pocket. But looking at, for example, let's say you retired and you have a big tax year that's going to push you into the 3.8% long-term capital gains rates, but the year after you're going to be in the 15% or even potentially in the 0%. Well, why not wait then? Understand what the risks are of the investments that you're in, but understanding also the timing and execution of it. Like right now, for example, we've got to look at harvesting any gains going into the next year, especially if next year is going to be a lower tax year. Or on the flip side, if this year's a lower tax year, but next year's going to be a bigger tax year, then maybe we do it this year. The other part of the strategy is if you're able to live and have taxable income that's in the 12% bracket or less, long-term capital gains rates for you are 0%. And so part of the tax strategy work is looking at how we're going to structure our paycheck to talk about what the taxable effect is of that paycheck. So for example, a lot of people say, hey, look, I can't live on 80 grand a year of taxable income. I need more than that. Okay, I'll buy that. Let's say you need 150, for example. Well, what that means is that we need to set up a paycheck of $12,500 a month. If you've got that money sitting in a checking account or a money market account, then why not use that for your paycheck? Bring your taxable income down. The only other thing you might have is dividend income. Use that as the year to then go and sell some of those highly appreciated positions. And by the way, even though ExxonMobil stock's down, as I mentioned earlier, if we have NUA shares at $14 a share, well, if we're selling them at 40, you still have gain there. If we can get the gain out tax-free, and then maybe even if you're just buying the stock back, I'm not recommending that, but even if you just wanted to ratchet up the basis so that the basis could be taken out tax-free, that's a pretty good strategy. And that's one where we want to integrate tax strategy with a lot of these ongoing discussions. Now, we also need to have a strategy for anyone who's retiring under the age of 59 and a half. How are we going to bridge your cash flows? And the reason for this is because retirement accounts, IRAs specifically, have a 10% penalty to take money out prior to the age of 59 and a half. And so we need to understand how are we going to bridge to get you there without having an impact on overall cash flow needs. So it might be savings, might be using those NUA shares. However, it means that you're going to have to sell the stock in order to be able to do it. A lot of people aren't willing to do that right now. Might be part-time work and consulting, You do have the ability to leave the savings plan at Voya, and once a year you can take money out penalty free. You still have to pay ordinary income, but it's penalty free. So we have to do a little bit of budgeting, but we can still use that as the mechanism to bridge. There's also a tax provision called 72T. And what this stands for is what's called the equal periodic payments. So you can turn a retirement account into a mini annuity stream for 5 years where you have to take out the exact same amount. It's not my favorite option simply because it kind of restricts our ability to access cash flow, but it does provide the ability to pull money out of an IRA account without paying a penalty. And then the last option is using lines of credit. Now, I'm not a huge fan of accumulating debt in order to bridge cash flows. That said, if we don't want to sell stock right now at lower price points, it might be a viable option. We're able to borrow, most lines of credit now are less than 2%. We have the ability to still collect the dividend yield at 9.5%. So it's covering the cost of the debt. But most importantly, we're preventing a 10% early withdrawal penalty. But again, it's important to understand the options. And if you're going to retire under the age of 59.5, know how we're going to bridge to get you over to avoid that 10% penalty as best we possibly can. The point is, it's complicated. We need to have a plan. We need to have a plan that's going to pull together all of the different components of a retirement plan, whether it's cash flow planning, estate planning, risk management, taxes, investment strategies, and and having the flexibility to react to whatever the environment is, whether it's law changes, rule changes, company changes. Put yourself in a position to be able to act quickly. All right. One of the other things we talk about is understanding your spending and understanding withdrawal rates. Now, this is just for illustrations, but let's just say that we had a rate of return of 5% with inflation of 2%, so a 3% roll rate. If you had a 3% withdrawal rate, it does look like your portfolio is going to last forever. That's not actually the case, but survivability of a portfolio is 99 years. 4% withdrawal rate will survive 43 years, 5% 29 years, 6% 22 years, 7% 18 years, and 8% 15 years. So part of the process really needs to be understanding how much are you withdrawing from your portfolio to see how long it's going to last. It's a leading indicator. And understand there are going to be years that we spend more than that. There's even years when you get to that age of required minimum distributions that those RMDs are forcing your tax rates higher, which actually force you to have to withdraw more. And so understanding the implications of your withdrawal rates and integrating that with your plan is extremely important. All right, so I'm going to jump right over. I wanted to talk real quickly. If you're going to consider hiring an advisor, a couple things we look at or would recommend looking at. First off, they've got to be a fiduciary. In today's age, anyone who has the ability to be compensated specifically for the investments that they're going into with commissions, you have to ask the question of, is that really in your best interest? We do think that they have to have a very transparent fee schedule and how they're being compensated, and it needs to be very, very clear. I also believe that any advisor needs to be a certified financial planner because CFPs have undergone the baseline level of education required for adequately servicing the needs of a retiring household. I do believe the EXXONMOBIL programs are very, very unique. I think every company's plans are very, very unique. Have an advisor who understands the nuances of those programs as well as all of the tax laws related to them. Has over 15 years of experience. They're able to manage their own portfolios. And then I also think it's important that they're open to discussions of different strategies. It's not just this is the only way that they manage money, for example, or the only way that they recommend structuring a financial plan. Have the flexibility and be able to have an open discussion around that. And then I do believe as they're doing planning work, that's great, but that plan needs to be the baseline for a lot of the future discussions you're having. So track performance versus the plan. And performance just doesn't mean how the portfolio is performing. It's also how's your spending doing? What variables have changed? That plan needs to be integrated in the overall. And then lastly, are they good translators? Can you understand them? I think it's very important. A lot of times people hire us because they themselves might be savvy enough to handle their financial affairs short term, but their spouse might not be. And so having a relationship in place is very important to them. And are they able to translate all of this over to the surviving spouse? I think that's an important part of the considerations as well. All right, a couple other things. I want to start, and I apologize, I'm moving a little quick because I want to make sure it's not going too long today. But when we get to that place when we're less than a year out, I call it the red zone. It's a football analogy, but when we're in the red zone, we want to make sure that we're executing flawlessly, no fumbles, no interceptions. And so this is where, again, we want to determine, to redefine, understand what your cash flow needs are, how much you want to spend. If you haven't hired an advisor, consider hiring one then, having trial accounts. Understand your cash flow plan, especially if you're under the age of 59 and a half. Understand investment strategies and how is that strategy going to provide your paycheck. And then within that period of time, we want to understand what discount rates are doing, what kind of implications those are going to have on the timing. We want to understand year-end leave rule and how that's going to impact vacation scenarios. And then we want to evaluate the work situation. Now, when you're 120 days out, this is where we start really executing. 120 days is significant because that's the earliest that you're eligible to request an intent to retire package. Now, when you go to actually request the package, you need to know the 3 key dates: last day on the payroll, first day of retirement, and your benefits commencement date. Now, all of those carry significance because that then translates over when you're eligible to retire. So at 120 days out, that's when we're going to request the intent to retire package. We're going to inform your supervisor of the key dates in writing. The timekeeper is going to submit your smart form. You'll also have to submit your pay in lieu of vacation form. And then once your intent to retire package comes back in, then at that point, we want to have it received. We want to be reviewing it with you and then have it back to benefits 35 days prior to commencement date. We jokingly throw these in, but that's where you also want to plan your retirement party, returning your laptop, your badge, and any mobile devices. All right, question came in on this. What about those who have volunteered but have not been verified yet, and we are told to wait to request the intent to retire package? Should we wait like being told? You know, this is all about execution and timing. And I would say that with regards to the EXXONMOBIL voluntary program, the disqualifiers for eligibility are those prior to the announcement that had submitted a retirement package already or had notified their supervisors in writing of those retirement dates. Requesting the package itself does not actually disqualify you, because requesting a package is not committing you to retirement. That said, I know why they're asking is because they don't want a whole bunch of people requesting packages that don't end up getting selected for the voluntary program, and then they've had a whole bunch of wasted packages. I do think that those that are going to go and they're over the age of 60, the most optimal benefit commencement date for you is going to be February the 1st. Now, these packages, they take anywhere from 3 to 5 weeks to produce. I have heard in one of my webinars, somebody said that they got as quickly as 7 days. I haven't really seen that. I recently did a call to benefits with one of our clients to request their package, and they were telling them 30 days. And if you think about it, let's say we wait until November 30th, which is when we're effectively going to know that we've been selected for the voluntary program, and then it takes them 30 days. Well, that means you're going to get the package at year end. There's no way we could get it back prior to December 25th, which is 35 days prior to your benefits commencement date of February the 1st. So that said, if you have the ability and other funds to be able to live on, again, because you're getting 4 months of severance, you should have the ability to have other funds to live on. I have no qualms in waiting until November 30th, because we'll then just use a March 1 benefit commencement date. We'll have the package back at year end. We just need to have it back to benefits by January the 25th in order to have everything executed correctly. I don't want to wait until February, for example, though, to request a March 1, because that creates a lot more delays than that. But I'm not really in the camp of feeling the need to have to wait, but if you're more comfortable doing so and ultimately they're telling you can't, then sure, wait. But I also think that you can raise your hand now if you've already volunteered for the program as well. All right, related to that intent to retire package. This is primarily related to the pension benefits. So it's going to go through all of the lump sum as well as all of the pension options and then the forms that you need to execute there. It does also contain information related to the health insurance program. You can't change the health insurance, but it does give you all the information there. Now, this is one, I want this done with us, your advisor. You know, one thing I remind our clients, we've done hundreds of these at this point. Doing it on your own, you know, we're making some irreversible decisions here, and execution is very important, but we want to complete the forms. We're going to go through and select lump sum versus annuity options. If we do the annuity, we need to select which type of annuity as well as any of the prospective tax withholdings. If we select the lump sum, we're also going to need to select the IRA custodian as to where that packet or that check is going to get mailed to. I always highlight the special tax notice that's in there. That's going to have significance a little bit later. But then when we're going through that package, there's going to be 3 places that are notarized, 2 by the participant, 1 by the spouse. If you have a supplemental pension plan or an additional payments plan, there's 1 additional place that needs to be notarized. And then, as I mentioned earlier, all of this needs to be back to benefits 35 days prior to the benefit commencement date. Otherwise, it gets delayed. So execution is very important. Timing is very important here. Now, I do get asked the question a lot of when should you consider delaying the pension? Well, first off, if you don't need the money right away. Second off, if you're under the age of 60, and if we are taking the lump sum and expect discount rates to fall. Recently, I've been getting the question a lot of, all right, I'm going to take the voluntary program, but I'm not 60 yet. I don't want to have the discount applied to my pension program. You still have the ability to defer commencement. So it's important. You can retire at any point in time, then you can defer commencing of the lump sum. And as long as we have other funds to live on and we see interest rates staying flat or going down, we should defer. As soon as we see rates going up, though, we need to have a discussion on the economic impact of not taking the pension program and understanding what that sequencing would look like. But my default would be, let's get the guaranteed 5% per year that EXXONMOBIL is imposing on the pension program. But if rates are going up and ultimately we're not getting the 5% anymore, then we need to have that conversation. General rule of thumb, every 1% movement in discount rates causes the lump sum number to go up or down by 10%. And remember, they move inverse to each other. So if rates go up by 1%, the pension program is going to go down by approximately 10. For the grandfather category, we're already modeling that the second quarter rates are going to be 25 basis points higher. So that's going to translate to about a 2.5% reduction. For the non-grandfather category, right now the projections are 0.07 increase. So again, less than a 1% movement in the lump sum. For most of you, the cash flows are offsetting that. And if you're under 60, you're actually going to have the actuarial adjustment that's going to help with EXXONMOBIL doing a little bit less of that discount. So that'll offset whatever the rate movement is there. All right. A couple other things related to the timeline here. So once you've effectively retired, this is when you're now eligible to be able to do a savings plan rollover. Had a quick question come in. Is the reduction discount on the lump sum prorated? Yes, it is prorated. So it's not an annualized reduction. It is based upon when your benefit commencement date is. Yeah. All right. Savings plan. Savings plan. This is something that we cannot do prior to actually retirement. And typically it takes them 3 to 5 days to have you in the system as effectively retired. We want to make sure that we, especially if you're over 59 and a half, you've not done any withdrawals and Roth conversions prior to the rollover, because that can impact some of the different things that we're going to be doing. But I also want to make sure that we're doing this after you're clear on your long-term plan, because the default is leave it at Voya. We want to understand the cash flow plan. We want to understand your NUA plan, as well as any tax implications, incorporating it with your overall estate plan and investment plans. And then we want to review all of the questions prior to the call. And then we would actually go to commence the call. So again, this typically is about a week after you've retired at earliest. There's nothing forcing you to do the rollover call, albeit I will say when you turn 72, you're going to have required minimum distributions, which the savings plan would force you to do. That could be a disqualifying event for NUA. And if you also have Roth 401k in the savings plan, they require to do RMDs on Roth's 401ks. Again, not Roth IRAs, but Roth 401ks have RMDs. So for both of those reasons, we typically see most folks will roll these out prior to the age of 72. Now, again, this is another thing that we want to be on the call with you. We've done hundreds of them. There are tax implications here that we want to make sure we're executing correctly. I will admit, my experience with Voya has not been very good for the last probably year. I'd say 60 to 70% of these have mistakes either on the call or after we've done the call with the reporting documents that they do are incorrect. And so we want to make sure that we're hand-holding you through that entire process. when we go through the savings plan, first thing, Voya is going to verify that you're eligible, that you've effectively been categorized as a retiree. They also will verify that you haven't had a divorce and that there's a quadro on the savings plan. Now, when we get on the call, we typically will introduce you. They're going to want to verify address, phone number. They will ask if you have read and received that special tax notice and waive your right to waiting 30 days. The answer needs to be yes. So that's why when we go through the package, we're going to review that document with you. But you're truthfully going to want to be able to say yes. So I do recommend reading it. It's great nighttime literature. Talks about the implications of moving money in between retirement accounts. Now, when we're on the phone with Voya, we're going to tell them what we're going to be doing with the stock, specifically if we're declaring NUA, what we want to do with any of the remaining shares. We're going to tell them what custodian to send the money to. We'll give them the address and the account numbers, and then what we're going to be doing with any of the after tax. So we're going to do this with the first representative, and then we get to wait on hold to be transferred over to a distribution specialist where we get to repeat the whole thing all over again. I typically find these savings plan rollover calls are taken anywhere from 45 minutes to 3.5 hours. So you can always tell what kind of mood I'm in with those longer ones. But yeah, they can have longer ones based on errors that are in the program. All right, I did have another question come in. The gain for deferring the lump sum if less than 60 and no longer working is not 5%, it's less than 2.5%. Well, it depends on your age, right? So that's why I said it's approximately 5% per year, but depends upon what age you are when you go to actually retire. And it is prorated based upon your benefit commencement date at the time of when you execute. Yeah. All right. This is where, again, I've mentioned this several times today, consultant advisor. We want to understand the implications of all of the different decisions that we're making, timing for Social Security, spending, management of overall account distributions, tax optimization strategies, integrating all of that with the different components. It is complicated. Let us run the numbers and help. As I mentioned, there is absolutely no cost, absolutely no obligation with running the plan with us. We do have some upcoming events. December 2nd, I'm going to be doing how discount rates affect the EXXONMOBIL lump sum. On December 9th, I'm going to be doing retirement income planning. And then on December, that's actually supposed to say 16th, we're going to be doing NUA and post-retirement income planning. Here's our contact information. We're going to reach out and thank you all for joining. At the end of the presentation, there is a survey. Really do love to get feedback. I know today's a longer one. This is typically one of our longer presentations. But if there's any questions, please don't hesitate. Feel free to reach out. Thank you very much. Take care.